video we are doing looking at is on CIT and VAT computation. So as much as we can, because of the volume of work that we have to do here, we are going to limit all the theoretical aspects for us. We can make available materials that can help us in the understanding of the theoretical aspects. But of course, as I go along with the video, as I go ahead in the video, I'm going to be explaining things orally so that we can have background to what we are actually doing. Because CIT, for instance, alone has a part, the capital allowance part, that takes a lot of time. And I don't want this video to be too long, basically. But I will make sure I make it as basic as possible so that everyone that picks up this video will be able to understand it easily. So we are looking at CIT, we are looking at VAT computation. CIT is company income tax. It is a tax that is levied on, that is charged on the profit of every company that operates in Nigeria, whether resident or non-resident. Why value added tax is a tax on goods, that is borne by the final consumer. And we're going to be seeing how each of them is being, computed. For CIT, CIT is regulated by the Company Income Tax Act, while VAT is regulated by the Value Added Tax Act. So basically, we have, just some data here. We have the profit and loss account, just a vague one. We also have a vague fixed asset register here. It does not belong to any company, it's just for the purpose of the training. So we have like a template that we have prepared just to maximize our time, but we're going to be going through it a step after the other that we have prepared. This material can be made available so that everyone can have this template, but it's something you can actually develop yourself by watching the video and understanding what is the rationale behind each of the things that we did. The next thing that we have here is a template for our capital allowance computation. And the final, okay, sorry, we talked about that before. So basically, we're going to be starting with our company income tax computation. That's our CIT computation. And the first thing to do in our CIT computation is the capital allowance computation. Capital allowance is just like saying depreciation for tax professionals. So we believe that because of the fact that depreciation is not uniform across companies, some companies would have charged 20% on their plant and machinery, for instance, while some other companies will charge 10%. That is the reason why tax laws now say, tax professionals have now said that let us allow for uniformity, so that we can subject everyone to the same metrics, for allowing the expenses, allowing the fact that they have used a qualifying capital expenditure for the purpose of generating a taxable income. So let us put everybody on the same pedestal. Let us have it like a standard rate for each of these qualifying capital expenditure. Pardon me, you know. So and that is what they have done. So on this side, we can always get the rates online on the finance federal FIRS platform, you know, on ICANN site and several websites. Some of our big fours also, publish some of these things. It's just at the tip of our fingers. So basically, but on this side, for the ones that are most common and the ones that we're going to be using here, I already put the rates here. So capital allowance, for capital allowance, we have initial allowance, we have annual allowance, and we have investment allowance, which is normally for plant and machinery and some other you know, qualifying capital expenditure. But from Finance Act 2023, it has said that starting from September 1, there won't be anything like investment allowance for plant and machinery any longer. So we're not going to be having any 10% allowance on our plant and machinery anymore. So let us just dive into this. You can see that all that we have done here is just to have a format. There's no formula. There's nothing. We're going to be the one to be imputing the formula as quickly as we can. So I'm going to be explaining along with you know the computation. So basically, calculating our capital allowance, we have a motor vehicle. We want to calculate capital allowance for our motor vehicle, for our furniture and fitting, for our plant and machinery. Okay, I think this is just the three qualifying capital expenditure that we have here. So I think it will be good for me to probably hide this column then. since those are the only ones that we have, so that they do not cause any confusion. Of course, for the final one, it's just the same principle. That's the reason why I'm managing it, just to minimize time, just to get the rates and do the exact same thing. So what I have here, for this template that we're going to be using, we're going to be using useful lives. And the way I've gotten this useful life is that initial allowance, just to create a very brief introduction, initial allowance is the allowance that is, given, granted on the qualifying capital expenditure that has just been acquired for a particular year. All right, so you just acquired your plant and machinery for the first time and you're using it for the first year. You are entitled to an initial allowance on it, one time allowance. While the annual allowance is the allowance that you enjoy on a yearly basis, like it sounds annual allowance. So to get our useful life is just to see, since these are in percentage, time percentage, right? It's just to say that 25%, how many, if motor vehicle is 25%, so how many years would that be? That would be 100 divided by 25, so we have 4 years. Plant will also be 25 divided by 100 divided by 25, rather 4 years, while this is 5 years. Yeah. So we're going to be taking the data that we're going to be that we'll be needing for this um, capital allowance computation from our fixed asset register, basically, because that's what we are computing our capital allowance on. So here we have the written down value brought forward, but in accounting term we normally have as balance carried forward or balance brought forward rather. In tax we call it written down value. We have the useful life, we have the addition in the year, right? We have the total asset, total costs, for that is available for allowance. We have the initial allowance, we have the annual allowance, and then we have the total allowance. Then the difference between our total for allowance and our total allowance will now give us the written down value that we're going to carry forward, for the year. So basically, for the sake of this training, we are going to assume that all of the assets that we are bringing forward already used 2 years, before the present year, before 2022. They already used 2 years. And what that means is that for us to get the remaining useful life, for motor vehicle, we have said that the total useful life, according to the regulation, is 4 years. So it means if it has used 2 years, the remaining years that it has remaining is 2 years. For furniture and fittings, we have said that the total useful life is 5 years, right? If it has used 2 years, then it means we have 3 years left. For plant and machinery, if it has used 2 years and we said the total useful life is 4 years, it means that's 2 years left. So, so basically, we're going to be linking the cost of these items from our fixed asset register. So let's bring in our so normally this should, because normally the written down value is not the same thing as balance brought forward. Written down value is written down value is the cost minus the cost minus the initial allowance minus the annual allowance, right? But for the sake of simplicity and for the sake of this training, if you have your written down value, just go ahead to populate with your written down value. But for the sake of this training, we are just going to like assume that our balance brought forward is our written down value brought forward, right? So let's do that. So register for motor vehicle is 1 million, and additions for the year. We don't have, so we put zero here. So additions for the year is, and this is zero. Our additions for the year would then be 5,000, I think, right? For motor vehicle, okay, 45,000. Okay, so this will be the sum of written down value and additions for the year. That's now available for allowance. All right. So let's have the sum here, sum total here. So I can just quickly compute the sum total by doing by doing my Alt plus, I can then extend it. Alright, and then extend it. So, I can copy this one, copy this, paste it here, copy, paste here, copy, paste, copy, paste, copy, paste. Just copy the formulas. By the time I'm just paste, by the time I'm populating the other ones, it'll just be pasting by itself. So, like I said, initial allowances enjoy one off. So it means that for this written down value brought forward, we're not going to have, they're not going to be enjoying any initial allowance because initial allowance would have been enjoyed before now. So that will be zero. But for this one, for the addition, we are going to have um, an initial allowance. And what is the rate of our initial allowance? That is 50, right? That's 50%. So all I just have to do is multiply by 50% or divide by 2. So I think that is better. Divide by 2. Let's just use this. Divide by 2. So once you the reason why I'm doing all of this again is if not for the sake of explanation, I would have just gotten my data populate straight up. You know, if it's not the first time I'm doing it for my company or the first time I'm doing it for the client, for instance, all I have to do is just to pick the one for the previous year and then adjust for the present year. But for the sake of explanation, is the reason I'm taking it a step at a time like this, and I would just probably just try um so this is for our annual allowance now. So our annual allowance is normally for a new asset, it would have been the cost minus the initial allowance. Let me write it somewhere. For a new asset, it will be the cost minus initial allowance minus annual allowance. Sorry, pardon me. It's annual allowance we want to compute. The cost, pardon me for that. Okay, let me do it well. Cost minus initial allowance divided by useful life. So there is a tweak here. So if it is a first time asset, like I said, and the asset is, for instance, was not acquired in at the beginning of the year, all we just have to do is to prorate. So we're going to prorate by the number of months that it's used in the year. So let's say X is the number of months that it's used divided by 12. All right. So we're going to just multiply it by that. So for instance, if it was acquired in June, for instance, we cannot enjoy annual allowance for the entire year. We only enjoy annual allowance for 6 months. That's what it means because we only use it from July to December. But proration does not concern initial allowance. It's only annual allowance that it concerns. So that being said, computes our but for assets that they have already enjoyed initial allowance on, all you just have to do for the subsequent years is just to divide the tax written down value by the useful life remaining All right. So basically that is it. But for this now, we have to um, subtract all of the allowances that we have enjoyed. So let me put the useful life first. Useful life for this one is 4 years, right? 4 years. So we subtract to get our annual allowance. Like I said, we'll subtract because it is the fourth time we are computing annual allowance on it. Those who are total for allowance minus our initial allowance divided by the useful life. So we want to put this in brackets. So by the time we just have this format, everything will just be to just be populating by itself. So the total allowance would then be initial plus annual. So I can copy that down. right? You can see that it populated itself because I already copied the formula for each of these things, for each of them. So the next thing for us to compute is compute our written down value. So and like I said, our written down value is the difference between our total for allowance minus our what minus our total allowance for the year. 500, 500. Then for this is 16. All right. So we have to copy this and so we can see the total written down value that is left as well. So we see that put in bold as well. So just reduce this so that I can enjoy. Okay, I don't like the way it was before. Okay, I hope it didn't affect anything. So let's go ahead. So the same thing for this as well. Just link this. I won't say much on this one again. Just link for this is for furnitures and fittings, right? So we are assuming. Don't forget that we are assuming. Sorry, I copied the wrong place. We are assuming that our tax standard value on our balance brought forward is the same. Like I said, if it is your first time, what you just have to request for is the tax computation for the previous year, you know, and compute and get your tax return value from that and bring it in for the present year as your car or as your brought forward. But for the sake of this training, I'm taking the balance card forward as my tax return value. All right, and the addition is what 100,000 for furniture and fittings. But for this one now, I said it has used 2 years, so 5 years is the entire useful life, but as used 2 years, it remains 3 years. But this will still have 5 years, right? So I can basically copy this since okay, let me do that. Addition for the year is 0. So for every formularized this thing up, I can copy it and bring it down. Since they have the same format and they have the same row reference and column reference, cell references rather. So copy and bring it down. Total for addition for instance, I can copy and bring it down here. Into level as well. I can copy and bring it down here. Just to see our work. So giving me 200,000. Okay, it's 100,000. Yeah. Okay. See, this should not be here. This should be under addition. That was what I was wondering. Should be under addition, right? 100,000. Okay. So we are good with that. The same thing here. I can copy this one, copy everything here, populate here. To keep the form, it's going to keep the formula for me. Can you see that? But we have to be careful here now. We have to be careful here because the rate of initial allowance for this one is not the same as this. We have to be careful. So for furnitures and fittings now, the rate of initial allowance is what? 25. So it means I have to divide by 4, not by 2. We have to be careful. When we are copying, we have to be careful. We have to divide it by 4, divide it by 4, not by 2, because the rate of initial allowance is different, right? So, but annual allowance, the rate of annual allowance is also different, so we have to be careful. Don't forget, we have to be careful. Initial allowance is the same thing. That one is just um, total for allowance divided by the useful life. But this one, we have to be careful with it because, okay, it's also, I think we are good for this one because we already adjusted, we already adjusted the useful life to 5. So it's going to keep that for us. So the same thing here. This is just sum, so we can copy and paste this one downwards as well. You can also copy this one and paste downwards. Copy just to keep our time. See, it's updating automatically because I don't know. To make sure we are fast with our work. Okay, so basically that is it. So for plant and machinery as well, assume that I'm writing down values. So we have this. Addition for is to 50,000, right? So this is zero. This is zero. So we can copy this, the formula for us and update the row reference. And that we did that. Initial allowance for initial allowance, we have to be careful here. So we have to update this one. We have not updated. We have to update this one. This is our initial allowance for plant and machinery. Now the initial allowance is 50%, right? So it means it's 2 years. We have to divide by two. Initial allowance is two, but this is we have not included this as four. So we can copy and paste. Copy and paste this one as well. Copy and paste. Populate by itself. This one as well. Yeah. It and keep our cell references by itself. So it's updating our cell references by itself. Updating by itself. Updating by itself. That's power of Excel. Updating by itself. So we don't waste much time on this one. So basically that is it. So just to make it, you can go ahead with summing up all of these allowances, all of these allowances, and just go ahead with your this thing like that. But what I want us to do is what I have done here is I have also kept a cell that summarizes everything for me, so I don't have to have tax written down value and everything. I just all I want to see is here now. All I want to see is the total allowance, on one line. So this is like the summary of this. This is like the summary of all of this. So, and this is the total that we now need. Oh, sorry, this is the total that we need. Let me paint it in red for the year. This is the total that we need for the year. Total allowance that we need for the year. So it's just there is nothing here. It just is equal to it's just linking each of the cells that everything that we have done here up here. It's just to link it here. Can you see that there's no formula here at all. It's just like a summary, just to make our work neat. That's what I've done it there as well. So this is what we have needed. That this is what we need, brother. Pardon me. So there's something I want us to do before we go ahead. Say for instance, we now want to compete for the following this next year. You know, all we just have to do is just to copy this, carry it forward, and paste it here. Come and paste it here. All right, and reduce our useful life by one. And that is this for that year. Can you see that? So easy. So that is it basically. So for instance, for this one, that we can now see that there is nothing anymore. All we just have to do is reduce this by 10 so that we can have a balance of 10. Reduce this by 10 so that we can have a balance of 10. That is all. That is all that we have to do. All that we have to do. But let us I want to show you that so that once we have a structured way of doing it, I mean, everything is set. Everything is set. So now that we have gotten our capital allowance, and this is our capital allowance for the year. Capital allowance for the year, the sum of the initial and the total and the annual allowance for each of the assets. Now that we have gotten that, let's go ahead to compute our tax. So, in the computation of our income tax, where would we start from? We start from the net profit, that is the profit before tax. We just link it to our profit before tax. And that's the reason why we have this for 2022. That's the reason why we have this here. That's the reason why we have this here. So what do? We go ahead to compute. We want to compute our what now? Our We want to compute our adjusted profits. Let's compute our adjusted profits. In computing our adjusted profit, all we just have to do is to add back all disallowable expenses, and that has been deducted before, and remove all the allowable expenses that has not been removed before. So, for instance, depreciation has been deducted before. We add it back. Where do we get our depreciation from? From our fixed asset register. So, depreciation for the year, we remove it. This is depreciation for the year. We remove it. We add it back because it has been deducted before, right? Profit or loss on disposal of fixed assets. Do we have that? We do not have that. So for as many disallowable expenses that you have, you add it here, you add them here, and then you add back. So once you do that, you have your adjusted profits. So once you do that, so any disallowable, so you can see that this is add or less. So any disallowable expenses will be added back. Any allowable expenses that has not been added before, that has not been removed before, will now be removed. All right. So all we just have to do here is to sum this and get our adjusted profits. Adjusted profit. So these are adjusted profit now. So if we have a balancing charge, say for instance here we have a disposal, for instance now. Plant and machinery we have 100%, 100,000 naira rather disposal. No? Disposal will have been in negative, right? It have been in negative. Let's say we have disposal here, right? Right. We would have computed a balancing allowance or a balancing charge. What does that mean? A balancing allowance is a case where the amount that you have sold the assets is less than the carrying amount of the asset, or is less than the tax written down value of the asset. All right. While balancing charge will be in the case where the selling price of your assets is more than the more than the carrying amount or the tax written down value of the assets for the particular year. All right. And what you, the tweak to it is that we have to restrict, you know, we have to restrict that carrying amount to the total allowance that we have enjoyed on the capital on the qualifying capital expenditure. That is, let me give us an instance. Although I do not plan to do this. So, for instance, if the selling price of our assets is 120,000, for instance, right? And the tax written down value is and the tax written down value, for instance, is say 80,000. This is the selling price. This is the tax written down value. So since our selling price is more than our tax written down value, right? It means that we we have made a gain, and so we are going to be charged. So we have a balancing charge here. Balancing charge of what? Of balancing charge of 120,000 minus 80,000 multiplied by the tax rate, the prevailing tax rate. So let's say if it is 30%, so we just say 30%. Okay, there is an issue there. Oh, okay. I, okay. So let's see. This is our balancing chart for the year. So we would have computed that, but in our case now, we do not have anything like that. So let's just go ahead. Where were we? So that we now have, I don't want this video to be too long. To be too long. So We do not have any balancing charge or balancing allowance. Like I said, balancing charge is in the case where our selling price is more than our tax written down value, while balancing allowances in the case where our tax written down value is more than our selling price. That is, we have made a loss. Okay. So our initial allowance now, our capital allowance now, our initial allowance, we just have to link, we have already computed it, we just have to link it. What's our total of our initial allowance? This is it. Link it. What's the total of our annual allowance? We have computed that, so we'll link it. Annual allowance, we've computed that, so we'll link it. All right. So according to Finance Act, if for instance this company is not a manufacturing company, you know, that is if it's just a trading company, there is there is a restriction on the amount of capital allowance that we can enjoy, you know, for for um for the particular year. So, and you're going to see what I'm talking about here. Let me remove all of this one so that we don't have any figure, any formats anywhere. We can just do it all by ourselves. So this is capital allowance brought forward. Do we have any capital allowance brought forward? Maybe we have the data for the previous year, for instance. Now we would have gotten that, but let's just see that we do not have any, right? Let's just say that we do not have any. Let's assume that we do not have any. Let's assume that they have enjoyed all of their capital allowance before the beginning of the year. So it means that our total allowance will now be the sum of everything, right? It's our total allowance now. But we have to restrict this. Like I said earlier, Finance Act says that if it's not a manufacturing company, restrict this to 2 over 3 of the adjusted profits. So let's see. 2 over 3. So divided by 3 times adjusted. This is our adjusted profits here, right? And the adjusted profits. Right? You see that our adjusted profit is more than the total allowance for the year. That's because we do not have like the figure for for the balance brought forward. So in this case now, since there is no since the 2/3 since 2/3% of 2/3 rather not percent 2/3 of our adjusted profits is more than the total allowance for the period, it means that we can allow everything that we have for that period. But if, for instance, this total allowance is more than 2/3 times adjusted profit, we have to restrict our the allowance that we can enjoy for that year to this 2/3. All right. Let's make it simple for ourselves. Let's say our net profit is just 500,000. All right. Let's say just 500,000. We can see that our adjusted profit is now 824, right? Now the 2/3 of our adjusted profit is now 536. It means that the amount that we can enjoy for this period is what? 536,000. And that's the amount that we can bring here. So Finance Act now says that the remaining amount carry it forward. Abi Company Income Tax Act, because now says that the remaining amount carry it forward. That is this minus this. All right. So this minus this carry it forward because this is the amount that we can enjoy for the year. Okay. So this is this is our capital allowance carried forward, right? Now that will now bring us to the accessible profits. The accessible profit will now be our adjusted profit less our capital allowance for the year. All right, so we have this minus for the year. All right, so now Our income tax, we are putting our accessible profit, right? Which is also known as the chargeable profit. So the next thing for us to do is to compute our income tax and our education tax. So now, the income tax rate, don't let us put any rate here yet. The income tax rate would be dependent on what the annual turnover of the company is. Like I said earlier, Finance Act 2020, did that. So, for instance, this company now, what is the annual turnover? The annual turnover is 4.5 billion, right? 4.5 billion naira. If the annual turnover is 4, it means they are large. It is a large company. So it means the rates will be 30%. But if it is not, the rate would have been not have been 30%, right? So it means our income tax will now be our accessible profit times 30%. 30%. 30%. Okay. So our education tax as well. Prior to Finance Act 2023, it used to be 2.5% of the adjusted profit, but now it is 3%. But let's use 2.5%. So this will be equal to 2.5% times adjusted profit, this profit here. And that gives us our total tax liability for the year. Total tax liability for the year. Right. Next thing for us to do, I also did a thought of this. The next thing for us to also do is CETA says that okay, you have computed the income tax, but you also need to compare what you have computed with the minimum tax because if, for instance, your tax liability is grossly low and we compute minimum tax and we see that your minimum tax is more than the computed tax, then the minimum tax will be applicable. All right. And what's our minimum tax? What's our minimum tax? Yeah, our minimum tax is 0.5% of our turnover, less, pardon, this is not correct. Less any frank investment income, less frank investment income, right? Frank investment income is like maybe, for instance, dividend or return on investment or dividend, on foreign, maybe on foreign investment and all of those things. That is a frank investment income is like an income that's withholding tax, for instance, is the final tax on that particular income. So there is no other tax that will be charged. That is what it's called. That is what it's called frank investment income. So So it means that we have to bring in our turnover here to be able to compute our minimum tax. Let's link it based to our POL, P&L. So what is our 0.5% of this now? 0.5% times this. So if we have any frank investment income, maybe income like as part of the revenue, we'll remove it. But this company does not seem to have any. So let's just have that. So our education tax. So you can see that this is our minimum tax now. It's way above the tax that we have computed. So apparently, this is the tax. This is the rate that will be applicable. This is tax liability that will be applicable. It has to be the higher of the minimum tax and the tax that is being computed normally. So we'll also just link our education tax that we have computed. Just link it, and then we have our total tax liability. So you have to now compare this with this. Which one is higher? We see that the one that we computed by our minimum tax is the highest, and that is the end for CIT. So quickly, I would like us to also go into VAT computation. That is very within 5 minutes. I want us to be done with that. So I'll just copy. So for VAT, let me just draw my boundary and That's 45. It's ABC Limited, like we have for the other ones. ABC Limited. So VAT normally is computed on on a monthly basis, right? But of course, according to Finance Act, any company that has not made up to 25 million is not liable to, you know, remit to pay VAT. Annual, like 25 billion annual revenue, like, so it means in essence that small companies are exempted from VAT. But how would they know if it is not the end of the year yet? So all they just have to be doing it, all that is expected for them to do is that they continue to, you know, file until the end of the year. But we have not seen any case where FIRS refunded for companies that did not eventually make up 25 million. But that is what is expected. VAT computation. We don't have any data yet, so we're just going to be using vague figures. Let's see, in accounting. Let's put this in accounting, right? So what we have to do in a computation of our VATs. Number one, we have to get our revenue for the month. The revenue for the month. Let's just say that the revenue for the month is 800,000. 800,000. Now, according to the first schedule of VAT, there are some items that are exempted from there's some items that are exempted from VAT. For instance, baby products, academic materials, agricultural like food items, and all of those things. We can read them up. They are exempted you know from VAT. So in that case, if those are part of the things that we actually sell, like I explained earlier, just to remind us, VAT is like a tax that is borne by the last consumer. It's a tax on goods and services that is borne by the last consumer, right? So it means that it's the person that like enjoyed the goods or the product or the services last that would bear the burden of VAT, right? So back to what I was saying, if for instance part of what we have sold is maybe diapers like baby product or maybe books or textbooks and maybe we sold jam and all of those things that they are not vatable. So we have to come and adjust for non-vatable items revenue. So once we have this format, we can keep using it. Non-vatable items, non-vatable sales or revenue or whatever we want to call them. So that is, you know, let's say that is, let's bring this here. Okay, let's say that is, okay, let's bring this here. Do this. So let's say that is maybe 200,000 of all of our total sales. So I like to have my stuff in brackets. Let me just adjust it here. Sorry. Okay, it's not going to allow me to do that. Let me just do it one after the other. Okay, it's not allowing me to do it. Let me just. Okay, why am I not able to adjust this thing? Okay. Okay. So I like to have it in brackets. This. Okay. So it means that our it means that our it means that um our vatable revenue or net vatable revenue, we can call it just vatable revenue. Vatable revenue People revenue for the period will now be what? Now be sum of this and this, right? So, sum of this and this, right? So we have variable revenue. So now there are two type of value added tax. There is the value added tax on our purchases, and there is a value added tax on our sales. The value added tax on our sales is known as, or the value added tax on our revenue or sales is known as the output VATs. The VAT that is going out, output VAT, you know. And you know the rate for this thing is 7%, right? Rate for VAT is 7%. Rate for VAT is 7%. Okay, we can even still have this here, actually. Just sorry, pardon me. I don't want to do this thing like this anymore. Presentation is also very, very important. Delete to the left. Presentation is very, very important. So let's just have this here. I don't know what's right. So we can compute our output VAT on this side of it. Our output VAT can be here 7.5% of our 7.5% of our variable revenue. That is after we have adjusted for none or zero VAT items. So this is our output VAT, right? Now we have to compute for our purchases too. Let's see our purchases, you know, for the month. This is for the month. It's 600,000, right? And 600,000. And the month the purchases is say 100,000. It's 100,000, right? It means that our variable purchases, it means that the amount that we only suffer VAT on is the net of the two purchases is what? The sum of these two, right? The sum of these two. Um, okay, okay, okay. Then our input VAT now, because we now have to compute our input VAT will be what? 7.5% of this variable purchases, right? Because our input VAT is on our purchases. 7.5% times 500,000. Okay. This. So it means our VAT payable will not be the difference between both. Will not be the difference between our output VAT and our input VAT. So I can put this one here. You can just say this is equal to this minus this. So it means that for the month of, say, for January, for the month of January now, The amount that we're expected to remit to the government is what? 7,500. 7,500. Like I said, I'm going to give you a little background on what withholding tax is. Withholding tax is just like an advance deduction, um, a deduction or like an advance payment of our CIT. So the reason for that is to aid, you know, compliance to income tax, to remittance of company income tax, or taxes generally, whether individual or company income tax. So, for instance, you have as a professional, for instance, you have been engaged by a company, you know, to do some services and all of that, or as a company you have engaged another company, maybe to service your generator. There are companies that actually do maybe generator servicing, plant servicing, and all of those things. The law is saying is that part of the service fee that you're supposed to pay to them, if it is an individual that you are engaging, deduct 5% of that service fee and remit to the state's inland revenue service. You know, but if it is a company, deduct 10%, get their tax identification number, and remit on their behalf 10% of their service fee to the Federal Inland Revenue Service. So the difference is now is that for corporate bodies it's mostly 10%, and it is remitted to the Federal Inland Revenue Service. While for individuals it is 5%, and it's remitted to states inland. It's mostly 5%, and it's remitted to the State Inland Revenue Service. For instance, if the person is resident in Lagos, remitted to LIRS. And all of this is an advance deduction, an advance payment rather, of CIT or PIT on behalf of the beneficiary. In the sense that when the beneficiary eventually wants to like pay their CIT or pay their PIT, they can use as a credit the deductions that have been made, the withholdings that have been remitted. They can be able to use it as a credit to reduce the tax liability for that year. And that is what withholding tax is about. I believe that it's a very, very simple thing. It's something that we can all read up by ourselves. And thank you so much for the time. Thank you for everything. Enjoy, enjoy, enjoy.